Topic 1. U.S. government debt has topped $40 trillion. Summary, 3 to 4 lines. The U.S. federal debt exceeded $40.05 trillion as of Tuesday, almost double the level from 10 years ago. July showed a large deficit and rising interest costs, with cumulative deficits and interest payments becoming major budget pressures. Long-term Treasury yields surged this summer, prompting the Treasury to expand buybacks to calm yields, which provided only short-term relief amid structural fiscal and inflation risks. Details: debt size. The Treasury reported total federal debt above $40.05 trillion as of Tuesday. Compared with about $19.4 trillion 10 years earlier, the debt has nearly doubled in a decade. Deficits and interest costs. The July deficit was $43.23 billion, the largest monthly gap since March 2021. Year-to-date deficits are roughly $1.8 trillion, and interest on Treasury debt since the start of the year approaches $1.2 trillion, making it one of the largest spending items aside from Social Security and Medicare. Treasury market volatility. This summer saw sharp rises in long-term yields such as 10 and 30-year Treasuries, with 30-year yields reaching the mid-5% range, the highest since 2007. Higher rates increase borrowing costs across mortgages, auto loans, and corporate credit, and boost market stress. Drivers of yield increases. A mix of large fiscal deficits from the pandemic and recent policies, heavy corporate bond issuance, notably for AI infrastructure, rising term premiums, inflation and Fed policy uncertainty, geopolitics, for example, Iran conflict, and higher oil prices all contributed. Treasury intervention buybacks. The Treasury said it would at least double reverse repurchase support in the 10 to 30-year sector, raising minimum operations from $2 billion to at least $4 billion per operation, effective from September 9th through November 4th, with further announcements to follow. The aim is to buy long-dated securities to soothe sharp yield moves. Market reaction short-term. Yields dropped sharply after the announcement, about -9 to -10 basis points for the 30-year and about -5 basis points for the 10-year, and stocks and crypto rallied briefly. However, yields largely rebounded the next trading day, showing the move may be only transient. Expert views and risks. Analysts say buybacks can ease pressures short-term, but do not resolve underlying fiscal or inflation problems. Frequent Treasury interventions could raise long-term risk premia or reduce the dollar's allure for investors. Key implication: expanded Treasury purchases are a shock-absorbing measure, but absent structural fiscal reform, high debt, large deficits, and elevated long-term yields could keep upward pressure on rates and market volatility. Topic 2. Fed minutes flagged the need for further rate hikes if inflation persists. Summary, 3-4 lines. July FOMC minutes showed many participants thought further rate hikes would be necessary if inflation failed to trend down toward 2%. The committee left the policy range at 3.0 through 3.75%. But 3 dissenters favored a 25 BP hike to avoid larger tightening later. The Fed plans broader discussions on balance sheet and securities holdings, while data show PCE inflation still above target and employment beginning to cool. Details: in the July 28 to 29 FOMC minutes, a majority of participants said that if inflation does not abate, additional policy tightening, meaning higher rates, would be needed. Participants assessed upside risks to inflation as larger than downside uncertainty. The meeting left the federal funds target range at 3.5 to 3.75%, vote 9 to 3. The 3 dissents supported a 25 basis point increase. Those dissenters argued that raising rates now would avoid later, steeper, and more costly tightening. The Fed reaffirmed that adjusting the federal funds rate range is the primary tool. It also plans a broad review of the balance sheet and securities holdings through a task force process to inform policy tools. Key data. Core indicators like the PCE price index remain